to, to look at your face compared to look at the screen, and then I don't see, I don't know what you're doing there. So I mean, just turn on your camera and see what is going on. Okay. um Mỹ Hằng, Quyên, and Minh Khôi, can you please turn on your camera? Okay. Minh Khôi, are you there, Khôi?
Or can you wait me for a second because I'm gathering at the COVID-19 for preparing my testing.
Okay, okay, sure. Okay, good luck for that. I hope
Yes,
you F10 F0. Okay.
I already
Okay.
been at zero for 5 days.
Okay. Sorry to hear that. So hopefully it's okay for you. It's okay. Now you can become F minus one. So I mean, all of us artists, I mean, will get F0. I mean, sometime even too many around us at the moment. Okay. Ping post. I mean, look, let's move on. Thuận, can you see my slide, Thuận?
Yes, very well, teacher.
Okay, thank you. Okay, so today we go to a new evaluation technique, and actually this is the most important evaluation technique in practice. Clearly, when you do evaluation, I mean, we just started and I see your internet connection is unstable. Too early, too early when we just started. Can you still hear me, View?
Yes, I can hear you.
Okay. Okay. So cash flow based valuation is the most popular method in valuation because when you look at the quality of the financial statement, if the company want to manipulate the cash flow, it will be the most difficult or the most challenging task they want to do it, right? Easily, I mean, they can manipulate the dividend number. Easily, I mean, they can manipulate the information presented in the income statement and in the balance sheet. For sure, they can be here and there. They can manipulate, I mean, the cash flow, but manipulating cash flow appeared to be the most challenging task for accountants. So that explains why the cash flow based valuation is the most popular technique in valuation when we use it all the time. So today we will focus on that. So again, before we go into this one, let I mean capture about I mean the valuation. The key component when you do the valuation is you try to work out what is the profit you are going to receive in the future, right? So clearly you need to forecast for the future. And then because you need to work out what is the present value, so you need to determine the discount rate. And the discount rate here is simply the cost of capital. And the cost of capital will reflect how risky your future payoff is. So if you are facing a very risky expected cash flow, then the discount rate will be very high and vice versa, right? So if you look at the numerator for this simple equation and general equation, you see that we can use dividend, we can use cash flow, we can use earnings in order to do the valuation. So last week we discussed about dividend. This week we focus on cash flow, and next lecture we focus on earnings. And as I say, the cash flow valuation is the most popular method when you do the valuation. And one of the reasons for that is it is the most difficult or the most challenging in order to manipulate the cash flow. So that explains the cash flow is, I mean, good in that sense. So, I mean, go back to the different approaches for the firm variation here. Again, we discussed about dividend already. And then today we discussed the free cash flow, and then we'll discuss the earning, right? So if you look for the, if you base on wealth of the company is distributed, right? So between debt, between equity holder. If you look for the free cash flow, you can ask a question, how much or what is the level of wealth which can be distributable, right? And if you look for the earnings or the net income, the one we cover, I mean, in the next lecture, we focus on, I mean, the wealth creation. So regardless of, I mean, what method you do, you can go to the valuation. You can ask me the question, in practice, do we need to use all the method here? The answer is no. The answer is no. You know why? Number one, you use two or three different methods, then they will produce, I mean, different figure for you. No doubt in that, right? So clearly, let's say from my experience, the most popular one we use is the free cash flow. And then we use the market information, the one we discussed on the week after next week, in order to supplement or in order to provide additional information to the number you get from here, right? Now, so clearly we prefer to use the free cash flow on that. Right? So now we focus on the cash flow. So why we really want to focus on cash flow? We focus on the cash flow because, I mean, in corporate finance, cash is king. It's not about how much your profit is. If you do not have enough cash in order to meet your short-term obligation. So in finance, cash is king. So on that basis, if you focus on cash flow, so you can see that, okay, I mean, how significant your company can survive, right? And survival, being survive, or the survival of your company will become the most important thing for you to consider. So this method actually try to measure the cash flow, and clearly how to measure that, that will be the focus in today's lecture. So I will show you the quick formula how we can measure the free cash flow, and then we apply it by looking at the, I mean, the example, and then we do some question together for you to understand how you can estimate the free cash flow based on the information presented in the financial statement of the company. Right. So clearly, I mean, if you look at, I mean, the point in time, so that the cash flow is generated and it is generated. So clearly it will be related to dividend paying capacity. Put it this way, if we do it correctly, if our assumption is considered, so regardless of what method you do, you will produce the same number. However, in practice, the different method you use, the different number you will achieve, right? So you will never be able to produce the same valuation result when you use different method, regardless of the input. It means that the information you use came from the same financial statement, but the final outcome from valuation will be different. Right? So, good.
Yes, teacher, I have a little concern about it. You mentioned that it's free to distribute this to the shareholder for the cash flow. So, what is the exact meaning of that?
Okay, so the exact meaning is, or clearly at the title recommend when you say free cash flow. So free here, it means that it is available for distribution. So when it's free, it means that it finishes all the financial obligation as the company. Okay, so it means that they pay for the employees, they pay for the supplier, they pay everything, and the cash flow in the company hands, it which is now free for them to distribute to anyone they want to. So actually the title recommend on that, right? Free is mean that it is not there for any specific purpose. It's free. It's free. It means that it can be distributed to stakeholders of the companies. In this case, and we focus on the equity holder or the debt holder. Okay, so later you will see that, okay, we try to estimate the cash flow available for distribution to equity holder. And we also discussed the way we estimate the cash flow, which is free for distribution to debt holder and equity holder. So we will go into that. But it means that there is no constraint for the cash flow if you want to use it. So that's what we mean free. Okay, so just go back to here. So we say, okay, so as I say, I mean, in principle or in theory, and later I will discuss why that is the case, why we use different method. I mean, we will produce different number. And in what circumstances or in what scenario we can expect that our figure should be the same regardless of the method you use, right? So rationale for using free cash flow. So the exercise cash is king. Cash generate value, right? So if that's the case, when you look at the free cash flow, you can say, okay, how much cash the company can generate and then distribute to investor. And when I say investor, what need to be mindful is clearly I'm talking about, equity holders as the owner, and I'm talking about the creditor or the one who lend money to the company. So by all means, regardless of you buy the bond or regardless of you buy the share from the company, you will become the investor for the company. Okay, so clearly we will on that. And clearly, when you make investment, so you think about the return, right? So clearly, if you base your valuation based on the cash flow, so then clearly you can compare the cash flow now and the future benefit if you decided to invest, your free cash in somewhere. So I put it in a simple language. In finance, cash is king. Cash is difficult to be manipulated. So when you, do the valuation, if you base on something which you believe it is very difficult, to be here and there. So then the level of confidence will be even higher on that. That given we focus here is, the you if you look for the from the equity point of view, so then you can use the CAPM, capital asset pricing model, in order to work out the cost of equity. Why I care about it? I care about it because if you use the free cash flow for equity holder, so you focus on equity, in that case, the discount rate you use should be the cost of equity, not the free cash flow for equity. Why is that? Because the cost of equity or equity is riskier compared to debt. So the cost of equity will be higher compared to the cost of capital. Am I right? And equity holder is riskier. So when you look at the present value, what is available for distribution to shareholders, then the discount rate should be higher. And the cost of equity, as we say, will be higher compared to the cost of capital. So if you look for CAPM quickly from here, the expected return on equity or on, let's say, Vinamilk depend on the risk-free rate, the beta, and the market risk premium. So you should be very familiar with that now, right? If you look for the cost of capital, then you see that the cost of equity will be one component on the cost of capital. Now they're in that chart. And the first one is the cost of debt or the YTM, the yield to maturity. And given the nature, you pay lower tax when you claim the interest expense as the cost component. So you only look for the effective, cost of debt, which is the one after tax. So that is, the way we can calculate the cost of capital. And you can see the cost of capital here is actually the cost of asset because I take into account creditors and equity holder at the same time. So you see that asset need to be funded by equity and debt. So when you work out the cost of capital or the cost of asset, so then you consider the cost for debt and the cost for equity, and that is a sensible thing to do, right? So now we go to a little bit about measuring free cash flow. Okay, when you learn finance, very important one balance sheet, income statement, and then the statement on cash flow, right? So if you look at the cash flow statement, it has subcomponents. One is, the cash flow for operating activities. The second one they call the cash flow for investing activities, and the last one, they call the cash flow for financing activity, right? Just a quick rundown on that. Any money in and out in relation to the operation of the company, they will be recorded under the cash flow for operation or the cash flow for operating activities, right? Anything in relation to buying or selling the asset, they will be recorded under cash flow for investing activities. Anything related to you borrow more money, or you retire your debt, or you issue new share, or you repurchase your share. So all cash flow like that will be recorded under the cash flow for financing activities. And when you look at the total, I mean the inflow or the outflow for operating activities, investing activities, financing activities, you will look the overall picture about the cash flow for the company. And actually, it is very important because the overall cash position of the company will represent how liquid the company is. It means that it can tell you the level of liquidity. Am I right? Let's say that when you look at the cash outflow for operation, the cash inflow for investing, the cash inflow for financing, and the total of three components produce, let's say, the inflow of 100,000 billion, for example, Vietnam đồng. The very important information for that is your company have a very high level of liquidity if you have a lot of cash inflow. Okay, so in order to do the valuation, right? Clearly, important point is you start from here. However, you need to do some rearrangement. So it can be here and there. The information came from financial statement with the focus on the cash flow. However, we need to do some rearrangement in order to compute the free cash flow. So it means that free cash flow valuation doesn't mean that you go to financial statement, you pick the number from the cash flow and you do the valuation. Now, very important point, that is the starting point where you pick the number, but you need to do some rearrangement on that in order to derive the free cash flow, which you will use, I mean, in your valuation. And I will show you how to do it, right? Okay. Clearly, I mean, if you try to measure the free cash flow, as I say, I mean, you start with the standard free cash flow and you rearrange some components there, and I will show you what you need to look on. So we say usually we start with the cash flow from operation. Because by all means, I know that if you look for Vietnam, I mean, for some companies, I mean, the money they receive or they pay for their main or their core business activities less than compared to the money, let's say, they handle for their secondary activity, right? The manufacturing company, but they do not focus on doing manufacturing, they focus on real estate trading. So in that case, you can see the cash flow for their, I mean, for their for their secondary, category is more significant. I'm not talking about it. In principle, for the company, the cash flow from their operation should be the most significant component, because I assume that when I run the company and the key business activities for my company is on manufacturing, so it means that the cash flow for my company should be in and out from that activity rather than from anything else, right? So we say, oh, just because of that, we usually, in order to measure the free cash flow for your valuation, we try to start from the cash flow from operation. Okay. However, I mean, that is standard practice, but it doesn't mean that you cannot start from the cash flow for investing activities or the cash flow for the financing activity. But the standard point is we start with the cash flow from operation. This is a very, I mean, concise one. Later, I will show you the one with very, very detailed. But what it really means from there is, if you try to measure the free cash flow for your valuation, so there are two different ones. The first one is the free cash flow for the asset, so it's older. So instead of you call the free cash flow for an asset, you can call a free cash flow for all debt and equity shareholder. I will come back on that. The second one you need to work out is the free cash flow for common equity stakeholder. So first one, you focus on the free cash flow for the asset, so including debt and equity stakeholders. Second one, you just focus on the stakeholder. Okay, so what they tell you from there is, okay, start with the cash flow from operating activity, right? So it stands for a cash flow from operation, and then you, I mean, you add when it is on the spend, and minus when it is a receipt for the net income cash flow. You look for all the chain. Cường, can you still hear me, Cường?
Yes, Mr. But it's quite lacking.
Okay, it's how about now? Is that good now?
Yes, yes.
Yeah, yeah. The
Can you
reason I asked the reason I asked because I saw okay, so whenever I see the signal, I mean on my screen side, your connection is unstable, so I will stop about 5 seconds, so you might not hear about that. Okay, cool.
can you see what can you say what you said 1 minute earlier again because actually it's quite lacking.
Okay, okay,
Thank
cool.
you.
Okay, so actually from here, what I say is, okay, when you do the valuation, two types of free cash flow you will do. The first one is free cash flow for the asset or the free cash flow for all debt and equity stakeholder. That is the first one you do. The second one you do is the free cash flow for common equity shareholder. Which means that you just focus on the owners of the company. Now, okay, so I mean, regardless of, I mean, which one you want to do, the starting point, you start with the free cash flow from operating activities. So cash flow from operation, right? You add or minus the net interest after tax. The key point here is about the after tax one. It means that you exclude the tax. When I go there, I will show you there, right? And then you add or you minus the chain requirement for liquidity. Look complicated, but of your cash flow, taking into consideration the cash flow for operation, the gain. When they look about a cash requirement for liquidity, it's more about your overall cash position from the cash flow statement. Okay, so if you focus on that, so now what you can see is we have you start with the cash flow from operation. It become a free cash flow from operation for all debt and equity. Remember, we still have a firm operation, so only firm operation. Not stop there yet. You go to the next one. You consider the cash flow for investing activities. And if you consider investing activity, you consider the net capital expenditure. It means that how much money you invest, how much money you get when you sell the asset, right? So when you take into account investing activity from the free cash flow from operation, you get the free cash flow for all debt and equity holder. This is the one I will use for my valuation. I say again, this line will be the one I will use for my valuation when I need to look at the angle of my valuation for both debt and equity shareholder. I will show you a much more detailed, I mean, table. I mean, after this one, just be mindful with me on that. If you want to consider for the free cash flow, I mean, for the common equity shareholder, right? Again, you start with the operating activities, right? But you see that here you don't care about the interest expense, but it is for creditors, right? But you do care about a cash requirement for liquidity. This component is the same with the other one, right? So now you go to a free cash flow for from operation for equity holder. You consider investing activity, which is similar to the free cash flow for the asset, right? But if you look at the previous one, they don't care about finance activity. But if you look for the free cash flow for common equity, you do care about it, right? What you do care from that is you take into account the financial activity. So you look for the debt cash flow, long-term debt, short-term debt. You look for the financing asset cash flow, and you look for the preferred stock cash flow. The last one not included in your free cash flow for debt and equity holders. The net interest after tax is not included in the free cash flow for common equity holder. So now I go to another one. It's a little bit, I mean, clearer, okay? A little bit clearer compared to what I just showed you. And then I show you a one with a very, very detailed one. This one just similar with the one I show you, but this one detail. Now you look at the way you measure the free cash flow for debt and equity and the free cash flow for common equity. Starting point, they same. Cash flow from operation, the FCF For the FCF, free cash flow for all debt and equity, you consider the net interest expense after tax. Here, you don't consider that. And then both of them consider for liquidity. So that's the same. Both of them consider for investing, so the same. And after investing, the free cash flow for asset or for all debt and equity stakeholder stop here. That is what you want for your valuation. But for the free cash flow for equity holder, you need to move on with your financing activity by taking into account inflow from your new borrowings, subtract cash outflow for repayment for long term and for short term financial asset cash flow. So let's say short-term and long-term investment securities, right? Prefer stock cash flow or even non-controlling interest cash flow. So it means that the cash flow from your investment, but I mean you don't report it in your financial statement because you own less than 50%. Okay, so that that comes to the free cash flow. So all this component here you take into account when you measure the free cash flow for equity holder, but not when you measure the free cash flow for the asset or for debt holder and equity holder. So this is a very good summary. I show you another one. Before I go back here, I show you another one. So if you really want to go to detail, okay. So here is what you can think of in terms of how you can derive the cash flow from operation, right? So you start with net income and you add or you subtract in terms of all the asset here, including the current asset and the non-current asset and liability. So you go to the next cash flow from operation, and then from here and our financial activity. Why I show you this one? I show you this one in order to emphasize two things, right? The accountant of the company are the one who do this one, not you, right? As the valuer, you don't need to do this one. The accountant will do it for you. That is rule number one. Number two, why I show you this one? I want to tell you the net change in cash, the last line here, it will be used in our valuation when we consider what is the current level of liquidity for the company. I say again, number one, the accountant of the company will be the one who prepare the financial statement. That's their responsibility, right? Number two, I want to tell you the overall balance for the cash flow from operation, cash flow from investment, and cash flow from financial activities, the net change in cash, it will tell you about this one. Let's go back to show you this one. About, where's that? About this one. That. The overall cash balance in the cash flow statement will tell you what is required for liquidity of the company. So that is something I want to emphasize on that. So again, I will show you, when we use the financial statement, and we will modify here and there in order to get the free cash flow for the asset and the free cash flow for equity holder. We will do it soon. Right. So if you want to do the evaluation, go back to here, you need the discount rate. And what I want to draw your attention is discount rate is the cost of equity. Okay, not the cost of capital, it's the cost of equity, right? The expected future free cash flow, you cover, let's say, for 5 years. So from year one to year five. Now, and then from year six and onward, you need to estimate what we call continuing free cash flow. It means we assume that everything remain the same from year six until indefinitely. Look complicated? No, it is not. If I tell you one by one, right? Okay, first one, very key component here. You need to determine is the free cash flow for equity holder. So I'm focused on the FCFE. The last one stands for equity holder. Just because of that, when you discount, you need to yield the cost of equity, RE. And the cost of equity can be estimated using capital asset pricing model. Okay? Are you with me? So the first component here, it will tell you what is the present value for your free cash flow for equity holder for the first 5 years. The 5 years you can forecast. Okay, so let's assume that you can forecast for the next 5 years. So then I have free cash flow for equity holder for year one, year two, year three, year four, year five. And then I know the cost of equity, so I can discount year one, so the power is one, year two, the power is two, and year five, the power is five. So the first component, it just stands for the present value. What the discount rate is the cost of equity for your free cash flow equity. Okay, so that is the first component. So this present value for the first 5 years, assume that you can estimate for 5 years in my formula. Now you look for the second component, right? Starting from year six, starting from year six, I assume that the free cash flow for equity will increase by a constant growth rate, let's say 1% per year or 3% per year. I say again, starting from year number six, I assume that every year my free cash flow for equity holder will increase by a constant growth rate. It needs to be constant. Say 1% in year six, 1% in year seven, 1% in year eight, 1% in year nine. For every year after year five, your free cash flow will increase by 1%. Fine. So you learn variation for stock already. When the growth rate become constant, you can use the dividend discount model, okay, in order to calculate the present value. Am I right? If I can remember, if I can remind you about the formula, right? What it tells you from there is the P0 equal D1 divided for the cost of equity minus G. So G stands for growth rate. Okay, so that is D0, or sorry, P0 depend on D1. Similar here, what I say is I can work out what is present value, but not present value at year zero. I should say what is the value at year five, right? For the cash flow in year 6, 7, 8, 9, 10. So I apply that formula. The FCFE will be my free cash flow for year 6, right? And then I divide it by RE minus G. So the first two components here, what does it tell you? It tells you the value at year 5, the value at year 5 for all the free cash flow from year 6, 7, 8, 9, 10, 11, and indefinitely. Why year 5? Because you only forecast for 5 years, right? So that is why I start with the present, the value at year 5 for all future cash flow from year 6 and onward. So the first two components tell you the value at year 5 or at year t for all free cash flow from year t plus 1 onward. And then I need to discount for 5 years in order to get the present value. Okay, so the way for you to see that easier is if you look t is 5. So for the first 5 years. So this one now will become 6 and this one will become 5. So if you use the free cash flow in year 6, it means that the value you calculate is in year 5. And in year 5, you need to discount back for 5 years in order to get the present value. Okay, so that is the meaning of the formula, the common equity shareholder. So that is for the free cash flow when you look for equity. If you look for the asset or the company, it's when you look for debt and equity together. So now I will use, the present value for the net estimate the free cash flow for asset. It means that for debt and equity stakeholders, right? And then no longer the cost of equity, but now the discount rate is the cost of capital. I say again, when you handle the free cash flow for the asset or the free cash flow for debt and equity stakeholder, you must use the cost of capital as the discount rate. The formula remain the same. Formula remain the same. The only difference here is you need to use the free cash flow for the asset, and you need to use the cost of capital as the discount rate. So clearly, I mean, they are two powerful formula, and there is nothing more than. Here they explain to you about the continuing value. So the first one is, I mean, the free cash flow for the asset in year number 6, and you use that to divide by cost of capital minus G. The first two components tell you what is the value at year T for all the free cash flow you are going to receive in year 67 and forever. And the last component just simply you try to work out the present value of the value at year 5. So clearly it's just the continuing value. Why you need to do it? It's just because you cannot you cannot forecast longer than that. So far, I mean, I haven't, I mean, demonstrate to you how to do sensitivity, but I will do it no doubt in next week lecture when I will use Excel, and I will show you how to use Excel to do all the sensitivity and effectively. I mean, if time allowed today, I can do it, but if not, then next week. Why we need to do the evaluate? Why we need to do the sensitivity? We need to do the sensitivity because variation is not the rocket science, right? You need to see different scenario in order to see what happened to you, right? I want to emphasize here the difference between sensitivity and scenario. They are different, right? When you say sensitivity, you only pick one input and you try to re-estimate the output. Okay. An example is, let's assume that you use the cost of equity 10% and your variation is 1,000. Now you want to see what happened to the value of the company if the cost of equity is actually 11%. If you do something like that, we call sensitivity. So you only pick one input for your analysis to see what happened to your output. However, if you consider 2 or 3 or 4 input at different point in time, then it will become the scenario. The example is, let's say you say at the moment the cost of equity is 10%, the growth rate is 1%, and the discount rate is let's say 7%. You want to run the new scenario where you say, no, cost of equity now is 11%. Growth rate is now 2%. So that will tell you another scenario, right? And then another scenario when you say no, cost of equity now 12%. Growth rate is 2%, and the discount is, or the cost of capital is, let's say 9%. So that is the difference between sensitivity analysis and scenario analysis. And again, that is compulsory for your assignment. So I will show you how to use Excel in order to do that sensitivity analysis. It's just a 5 minutes demonstration. It's not, I mean, difficult at all. So, by all means, the free cash flow valuation is the focus on free cash flow, and you believe that, I mean, the cash flow. Why the cash flow is difficult to be manipulated? Because when it comes to you, so that it must come out from someone else. When the cash flow came out of you, so it needs to go to somewhere else. So at least there is, I mean, the possibility to double check. So that's why it is important. And the cash flow focus on, I mean, the operation. The cash flow will cover every single decision for the company, and that becomes very important one. Then we want to confirm the method is widely used in practice. Disadvantage, to be honest, I mean, every variation method does have a disadvantage. Time consuming, oh my goodness, everything is time consuming. And then the continuing value. So the last, I mean, not the first 5 years, but the value you estimate from year 6 indefinitely, I mean, it dominates the total value. So it's extremely sensitive to the assumption. And actually, is that true? I mean, happen because of this method. No, it happened to all the method in valuation. Because when you do the valuation for the project, it lasts for 20 years for your project. So that's very easy. No problem for that. But when you try to do valuation for the company, the standard assumption is the company will stay for life. And if it is stay for life, so what happened? You need to forecast for 5 years and then you let it go to remain, I mean, the same for years it and on that. So clearly, I mean, it's not about only for this one, but it occurs for all the valuation. That so clearly, that is the key point for the valuation based on based on the free cash flow. We do the question first. Okay, we do some question first, and then we will go back to use the Excel file to demonstrate how you can do valuation in practice using dividend we learned last week and free cash flow. Okay, so now we do some question first so you can get the idea how you can measure the free cash flow for equity holder, how you can measure the free cash flow for the asset, it's meant for debt and for equity holder. We keep it simple first before we go into I mean complicated one. So I am share you I mean the question from the book. I'm not sure if that is the question you want to do it, but as I say in your final exam, I mean I asked you a lot for this chapter, so I want to discuss I mean some question with you rather than leaving it all for Lynn. Okay, so the first one, just a second, I would need to show the question to you because I'm not sure you have the book with you. Here it is. Now, just a second. The question I want you to do now with me is, okay, I want you to do question number, what is that? No, not that one first. I want to do, okay, here it is. Okay, I will show you the question from the book here. Jim, can you see the book on the screen yet, Jim?
No, I haven't. Oh yeah, I can see now.
Okay, so clearly you can see, I mean, question 12, 10 easy, I leave it for you, but I mean, I want to do now with you, I mean, question 12, 11. And this question is about, okay, calculating free cash flow because I want to demonstrate to you when you look at the income statement, when you look at the financial statement, how can you calculate the free cash flow? That is what I want to demonstrate to you. They say that this sporting goods is a chain of large sporting goods retail offering abroad of brand name sporting good equipment, apparel, footwear. The company sport good is initial public offer. Okay, this A belong to I mean another question. Okay, so don't look at that table, it's confusing. I'm in the book in the fiscal year 2003. And then they say the company have grown its chain of retail, blah, blah, blah. At the end of the 2009, they operate 409 store and 40 states in the US. So clearly it's all the information, right? Exhibit 12.13, so not this one. This one is 12.12 for the other question, right? Exhibit 12.13 present information from the statement of cash flow and income statement for the fiscal year ending 0709. The company required all of its cash and cash equivalent for operating liquidity. So it means that all the cash and cash equivalent for operating liquidity and report no interest income on income statement. The average income tax is, 40%. So what I want you here is you need to work out what is the free cash flow to all debt and equity holder, and what is the free cash flow for equity holder. And the information you need to look at here is actually from here. Actually from here. So this is the information we need to use. It from the cash flow statement, right? From the statement of cash flow, from there, and then we need to work out from this information. We need to work out how we can calculate the free cash flow for the company. That I go back to this slide. I show you a formula again, and then if you want, so then you can, and if assume that you don't have a book with you, you can take the picture quickly. For what we should use, right? Is this one or that slide, the way you work out the free cash flow for all debt and equity stakeholder by consider all component here. And this is, when you need to yield to work out the free cash flow for common equity shareholder. If you want more detail, so then here is the one, it is more detailed this side, where you start, what you add, what you minus, and then this is the second page for the free cash flow for equity. Okay, take the picture of this one if you want to, and if you cannot open, the book, or if you cannot open the slide, you can use your phone and take the picture of this one before I go back to the question, and I show you how you can look at, the figure. Um, Vic can you see my lecture slide, Vic?
Yes, teacher.
Okay, so if you want to take the picture or whatsoever, do it now before we do the question together. Okay, ready? Okay, now I go back and I will show the book to you. Okay, I will show the book to you. Where it is, and clearly, later I can send you full solution. If you want to, and I assume that Lynn will send you full solution if you want to. Oh, sorry, I'm confused. Just a second. Okay, my phone, can you see the book again, my phone?
Yes, I can.
Okay, good. So clearly, if you look at the number here, can someone tell me? Can someone tell me? What is the starting point when you try to work out the free cash flow? What is the starting point? Which one we should start with?
The operations.
Yes, a cash flow from operation, right? Do I know the cash flow from operation from here?
Yes.
Yes, clearly you can see that from here. Am I right? Yes or no? Right. So that's the first one. Sorry, let's double check to they say what you want us to do. The first one, so I'm doing for the first one. So they say beginning with cash flow from operating activities, calculate a free cash flow to all debt and equity capital stakeholders. for 3 years, 7, 8, 9. Okay, so they ask you to start with the operating activity, the cash flow, and then you need to make some adjustment to say, I mean, how you do that. Okay, I'm sorry, but I need to now you can take note here in terms of what adjustment you need to look for it. The first one is you look at the interest after tax. Okay, and if you want to know the interest after tax, so then clearly you just need to know, okay, um, um, is that the how much is the interest, and you just consider what is the tax, so then you can work out the interest you need to pay after tax. Okay, and then that is the first one. I'm right. And then the second one, you need to look at it based on this one. You can see if I offer from there is in terms of the change in the required, the cash required for liquidity. So two components here, right? So they say, okay, subtract an increase or add a decrease in cash required for purpose of liquidity for operation. So that is something need to consider, right? And in the question, they did tell you something like the company decided to use all the cash for the operation purpose. So when you consider, when you start with the cash flow from operating activities, you consider the net interest after tax, right? If that interest is spent, so you add, but if that is the interest income, so then you subtract. And I remember when we read the case study, they say that there is no interest income. So we check if they have any interest spent, but I remember there is no interest income there. And then you consider for the change in the liquidity. So what you get is the free cash flow from operation for all debt and equity from operation. Okay, so not yet. So from operation, you then consider the net capital spending, the net capital spending. Okay. So now if you go down, I go back to and I will okay. I will show where the number. Okay, where we can get the number, and then what is or how can we put it in for okay. So okay, I show the book to you again. Just a second, please. I will show the book to you again. Cường, can you see the book now, Cường?
Not yet.
Okay. Sorry, just a second. Uh, see it now, Cường.
Teacher, still see
Okay. See it now.
yeah, yes, teacher.
Okay. Okay. So let's go. Okay. Hopefully you remember what I tell you in there. So we start with the flow from operating activities. We're gonna get that. So I mean, using your whatsoever, pick the number here for me, please. So we are doing for 3 years, 9, 8, and 7. So you get here 159, 60, and 159. Okay. So the first three number I need to handle that. Right. So that's the first one. What is the second component? What is what is the second? I need to the in we pay. And when you consider for the interest, we pay, so then you just say, okay, look for in terms of interest. Where you can get that information is from the interest. I remember you know that income is something here. Where is that? When I read the question with you, they say they have a no interest, have a no interest. And the next component, you see that is the cash required. The cash required for what? The cash required for operating activity, for liquidity. I'm sorry, a cash required for liquidity, right? So just before I show you how to pick the number, I go to that very important information in the case study they provided to you. I show you here. They say here, look here, please. The company require all of its cash and cash equivalent for operating liquidity. So clearly they tell you where to pick the number. Okay, so they need to use all the cash and cash equivalent, all the cash for operating liquidity. So if that's the case, you're going to fit the table here. I show you how you pick the number. Right? Where is that? So this is the one. This is the one. The net increase, if it is a positive, or decrease in cash, if it is a negative. However, however, what you need to be mindful here is, right? Right. What you need to be really mindful here is, right? Here, when you look at the cash flow from the company, right? So what they tell you is in 2009, taking into account operating, investing, and financing, the company is facing the inflow of 24,530. All right, so it represents an increase in cash, and this is the cash flow, so an in or a cash inflow. Right, when you do the valuation, right, if it represents now, I mean they have the cash, so then clearly you need to observe all the cash in order to improve your liquidity. So what it really means is I am going to subtract this figure, not add it. I say again, I am going to subtract 24,000 out of my free cash flow for equity holders. And the reason for that is because I need to observe this amount in order to improve liquidity. Similar reasoning, it represents the cash outflow. So in order to maintain the liquidity, I need to add I need to add this amount. I'll put it this way, right? Minus from minus, so then it become the positive. Also, if you don't want to provide reasoning, so you just need to minus from minus 85, so it become 85. But if the reasoning in the white up, because the cash flow represent the outflow, so the company need to consider that to put it in terms of the value to make sure that the company maintain liquidity. Put it this way, you minus this number for 2009, you add this number for 2008 and you minus this number for 2007, right? So you add everything I just said. I just repeat for 2009. You did not miss anything because I stopped when I see the internet signal unstable. Okay, so I just do again for 2009, right? You take 1,059 sorry, 159,676. I take this number, right? Minus, oh, sorry, add the after tax of this one, 8,021, add this one, 60% of this one, and then minus 24,530. What I get is the free cash flow from operation. So not the final number, yes, but it is the free cash flow from operation. And then I consider the investing activity. So the investing activity here, I need to go to see where is my investing activity. My investing activity is actually outflow of 144,000, and that is what you will get. Okay, let us tell you the number. Okay, let us tell you the number. I just do for 2009 and I will provide full solution to you. 159, right? 60% of 8,000 is 4,813. 4813. So I take 159,676 8 or plus 4,800 4813, and then minus for 24,530. What I get is for the free cash flow from operation 139,959, 139,959, and then 139,959. Then I subtract 144,194. My final number for that is negative or outflow 4,235. 4,235. Okay, so that represents the free cash flow to all debt and equity shareholder. So clearly you see that I am closely following the guys from the slide in order to derive the free cash flow for debt and equity holders. The starting point is you start with the cash flow from operation. You consider the interest you pay or the interest income. You consider the amount of cash you want to maintain liquidity. The total will tell you a free cash flow from operation. And then you take into account the investing cash flow. That the final number you get is the free cash flow to all debt and equity shareholders. So the relevant number for my calculation in this example is this one, the first one, this one, the second one, and then where else? And then this is, sorry, I say again, I say again, I say again. This is the first one. I need to use that. The second one is this number, right? The next one is this number, and then the final one is that number. So that is what I'm going to use to work out the free cash flow for um, um, all debt and equity stakeholder. So you can do the same for 2008 and 2009, and I can request link to send solution to you. Okay, so that is the first one. And guys, I mean, when you are, I mean, in this game, I mean, you do just, some example. Let's say if you go home, you do for me question 10 or question 12, 10. I'm the one before. You will see that, I mean, everything will be the same. That. Okay, the next one, just before I give you the break, the next one I want to do is we just need to look at again here, here, beginning with the cash flow from operating activity, calculate free cash flow for common equity shareholder. So now we need to do it, but for equity shareholder. Right. So again, just before I show you back again the slide so that you are ready to go with me. Okay. Thuận, can you see my slide again, Thuận?
Not yet, teacher.
It now em. Okay. Okay. So what you can see for me, you start with the operating cash fraction. That's what they want you to. You add or subtract. So this is similar what this one. Okay. The change in cash required for liquidity. Look, subtract an increase or add a decrease. Make sense? Make sense? Subtract an increase or add a decrease. It means that if you see a positive, an inflow, subtract, because you need to observe it. But if you see a negative, an outflow, you need to put into that. So you call add. So that is similar what here, easy. That's what you get, free cash flow from operation for equity. Not the final number, yes. Don't care about the interest after tax. So that is the first one. And then the second one, it's just the same with the one you just did in terms of investing activities. I'm right. It's just the same, right? Now you go to the next one is the different. The different here. The first one is they ask you to look for the debt cash flow. It's been that, I mean, look for debt. You add cash inflow from new borrowing or subtract cash outflow for repayment. Short and long term consider. Focus only on interest bearing debt. It means that account payable don't care about it. Okay, anything with the interest, right? So that is the first component you need to be mindful. Short term and long term borrowing or repayment. That is the first component you need to consider. The second component is, I mean, financial asset. It means that your invested, right? Short-term, long-term investment security. So you invest, company invest in stock. They have a certain, I mean, a trading position. That is when you take it into account. Okay. And then the next one is you look for the preferred stock cash flow, preferred stock cash flow. If they have a new issue of preferred stock, you add, but you subtract if they retirement preferred stock. It means they buy back preferred stock. And then you consider non-controlling interest. So I say again, non-controlling interest simply means you have the stack you have the ownership somewhere, but it is, I mean, less than 50%. So that's what we call the non-controlling interest entity. Okay. Let's say for Vinamilk, for example, they have about 25 subsidiaries. So it means that they own more than 50%, and it will be recorded in their financial statement. But Vinamilk, I mean, can invest somewhere, but it's only 20% of the asset. So in that case, Vinamilk cannot control that entity. So it is not considered the subsidiary of Vinamilk, but I will call something like non-controlling interest. So it means that, okay, I have interest, but I have a no control on that. So you add cash inflow from new investment, and then you subtract outflow for non-controlling interest. So including interest, retirement, and dividend payment. So you can see that, I mean, the first one very similar with here, but the last one you need to pick the information. So focus on the financing activities. Okay. So now I go back to share you the book. Khương, can you see the book of Khương?
Not yet, teacher. It's remain the slide. It's not sent to the book yet.
Get it now, em?
Yes, yes, yeah. Yes.
Okay.
Book now.
Okay. Okay. So I try to work out the free cash flow from common equity shareholder. Okay. I do 1 year, 2009, and the same principle will be applied. First one, you remember from what I just showed you from that slide. You start with the cash flow from operating activities. What number is that? This is this number. Okay, 159,676. That is the number I want. The next one, for sure, remember, I don't care about the interest pay or the interest income, am I right? But the second number, I jump into it. What I jump into that? I jump into that is the cash to maintain the liquidity. Where is that? Where? Here, the 24,000. Subtract, am I right? You need to minus 24,530. Okay, so you get the 159,676. You minus for 24,530. So what you get is 135,146 positive. It's been inflow 135,146, and that is the free cash flow from operation for equity holders. Okay, so now I focus on investing activity. All right. So investing activity, I look at it is this number minus 144,194. So I look for this one, invest activity. Okay, now I need to look at, I mean, something we see from there, right? Right. The first one is, remember, any short-term investment, you need to, so the two numbers you need to handle this pair 11874, right? So that is the first number, the first two numbers I'm going to use. I go to next one. Payment on long-term debt or capital lease. So yes, this one is relevant as well, right? This one is relevant. So clearly, if you look for that, if you say whether what you get is this number or not, I think that that should be equal to 13,894. Okay, now let's double check the number to see if our free cash flow to common shareholder is this number or not. Okay, let's double check. First one is, if you can use your calculator, you put 159,676. That's the first number, right? You then minus for 24 24530. Okay, so what you get will be 135146. That is the free cash flow from operation. 135146 and 135146. You consider the cash flow for investing activities 144194 negative. So you get the certain number. Right, I don't know. And then you add 11. Sorry, and then you add, sorry, and then you subtract 9927. And then you add 11,874. And then you subtract 6793. What you should be able to get is 13894. And this one is also a free cash flow to uh, common equity. That now I should say negative. Now, if you do the calculation, the number you get should be minus 13894. So it opposite with the proceed from sale of common stock. Why is that? Because you need to subtract it from your cash flow calculation. Okay, so actually, if you do a couple of questions like that, you see that you know where to pick the number. And I will show you, the more extensive, calculation, but when they use a lot of accounting number in the Excel file. Okay, so that is the way we handle, the way we work out for the free cash flow, um, for debt and equity, and free cash flow for equity holder. And you will use, that cash flow in order to do the valuation. Now, in order to do the valuation using the framework we applied. Okay, for C, for D, I think I will let it. For Lynn to handle with you, but it's just the reasoning question, and I will request. Lynn send solution to you. Um, Thuận, can I ask you a question, please? When chị Linh did the question in the class, did Lynn provide all solution to you? Yes.
Yeah. First, she asked us to present our work, and then she comment on our work. And after the last, she also post the solution file on the e-learning.
Okay, okay. When she posts solution file to you, she posts solution for the selected question, or she posts solution for everything for the whole chapter.
She just post some question that she asked us to do. Yeah.
Okay, okay. For sure. Lynn follow closely. The requirement from the publisher. However, what I want to tell you is, if you keen to do more question compared to, Lynn delivered to you, and you are not sure you do it correct or not, so you can talk to me. You can talk to me, and I will consider, and I can provide solution to you. Okay. So if you want to have something to double check, but it doesn't mean that you just simply send me email say, Dude, can you forward me the solution for the whole book? So clearly I will say no. I would say no, because I'm not allowed to do something like that. But if you try to do some more question at your end, on top of the list Lynn prepared for you, and if you want to get solution to double check, I'm very happy to explain anything you stop for that question, and I'm happy to provide full workout solution to you. When you demonstrate to me, you try to work out that question, because I don't really want you to be limited in the question. We consider, that important. But if you really want to go beyond that and you need solution, just let me know. Okay. I do not have full solution in my hand at the moment, but I know that Lynn have it, and for sure, I'm a full-time lecturer here, so I can request any solution. I mean, I have, and the book we use, I mean, very, very famous. So for sure, solution should be available, and I should be able to provide them to you. Okay, so I mean, if you do more than that, just let me know. I'm happy to provide additional solution to you. Okay, okay. Okay, so that's just the way it's just the way how to measure the free cash flow for debt and for equity holder. And then I strongly recommend you to go home to do, I mean, the question before that by looking at their financial statement and then pick the number like the way I just demonstrate to you. Uh, After the prep, we do one more question. It is the exam type question. And then I go to demonstrate using the Excel file to you. Okay, I give you 10 minutes prep. Come back in 10 minutes. So that should be what time is that now? There 4:55. So can you please be back at 5:05 your time? Okay. I see you in 10 minutes. We do one more question, the exam type question before I jump into the Excel file again. Okay, see you guys. See you in 10 minutes. Các bạn tại view đi rồi các bạn chắc chắn là mới học thì nó sẽ bị confuse, các bạn chịu khó về các bạn làm bài tập lại. Nếu mà các bạn vẫn confuse các bạn có thể email cho thầy. Như nãy thầy nói rằng là ờ, rõ ràng rằng là vì trong lớp có view nên là không không thì Vietnamese nó không appropriate, tại vì view sẽ confuse và tội nghiệp cho cậu ta. Nhưng mà các bạn học xong các bạn cảm thấy gì khó các bạn thể gửi email cho thầy. Còn nếu mà làm bài tập thêm mà cô Linh không có cung cấp solution thì các bạn cứ làm thêm, và các bạn muốn double check thì các bạn liên hệ với thầy, thì thầy sẽ cung cấp thêm cho các bạn. Ok, ok, tranh thủ nghĩ chúng ta sẽ gặp lại sau 9 phút. Ok, bye mọi người. Nhiên Hồ, can you see my book now, Nhiên?
Yes, I can see the book now.
Okay, thank you. Okay, now the exam type question. I want you to do question 12.12 for me, please. Okay. How many? We have up to D. We have up to E. Okay. I let you have 3 minutes for you to read up to C, and then we do together before you do D and E. Okay. Let's go read the question, and we do together from A, B, and C. Okay, let I read the question together and I analyze for you. The topic here is about the leverage buyout. We have a very interesting lecture on the leverage buyout. The leverage buyout simply means your company go out to buy another company. That is the M&A, merger and acquisition. However, if you go out to borrow a new company and you borrow a lot of money, in order to do it, so then clearly it will be called the LBO, leverage buyout. It means that you borrow money to buy a company. This is the exam type question. Okay, for sure the figures are different no doubt in that, but that will be the exam type question. The question here is my department store company are called my upright retail department store chain throughout the US. Assume that at the end of year two, the balance sheet report that this amount 4.6 billion and common equity book value 3.9 billion. The market value for common stock 6.7. What? The market value of each common stock is 6,705, and its market value is sorry, its market equity beta is 0.88. I think that this number should be 6,705 million. Okay, so that should be the one. Yeah. Um, so that is the market value for equity. So this one should be million. Okay. Assume that the equity buyout group is considering an LBO of money. It means they borrow money in order to buy money as of the beginning of year three. Okay, so now year two, they consider for year three. The group intend to finance the buyout with 25% equity and 75% debt. So you see that they borrow a lot in order to buy the company. That's why they call the leverage buyout. 75% debt carry in an interest of 10%. Assume that the group project that the free cash flow to all debt or equity capital stakeholder will be as follows. So this is the free cash flow to all debt and equity. Why is that? You might need to do the valuation. I'm right? And if it is the free cash flow for all debt and equity, you need to use the cost of capital. I'm right. If it is the free cash flow for equity, so then the discount rate is the cost of equity. But if it is the free cash flow for debt and equity, so then you must use the cost of capital as the discount rate. So all the numbers here, I mean future, don't forget you are in year two now. Okay, so year three, it means that 1 year from the current year. Year three, year four, year five, year six, and you go to year 12. The group project free cash flow to grow 3% annually year after year 12. What it really means is from year 13, right? Every year a free cash flow will increase by 3%. So you can use the dividend discount model in order to calculate the value at year 12 for all the free cash flow in year 13, 14, 15, and so on. Easy. This problem set forth the step you might follow in define my and the value to place on the form. The first one is they say compute the asset, unlevered market equity. It means that asset beta means unlevered beta. It is the beta when the company borrow no debt. I say it. The asset beta is the unlevered beta. It is the beta when the company borrow no debt. So the first one is they say compute the asset beta before consideration of the LPO. Assume that the book value of debt equals its market value and the income tax rate is 35%. Guys, in the exam, you don't need to memorize the formula. You don't need to do it. All the formula will be provided to you in the exam paper. Your responsibility is to understand what formula is going to be used and where you can look for the input. Okay, so don't care about the formula. So in this case, there is the formula for you to convert. The equity beta here is 0.88 is the beta for the company when the company borrow debt, and it is very obvious because they have the debt value here. That's why this beta is equity beta. The formula somewhere in your slide here, they refer you back to see chapter 11. So I will try my best to go back to chapter 11 and I show you the formula on that. Okay, so I need to go quickly, so I make it to be smaller. So I will show you the formula how you can convert. Oh, we are still in 12. So they say go for 11. So just be mindful with me. I will show you the formula you are going to use. No, not this one. No, not that one. Excuse me. Uh, Not this one. Sorry about that. I should be able to try it. And here you are. Here you are. Here you are. Okay. This is the formula. This is the formula. Show you the link between the equity beta and the asset beta. Okay. So I mean, if you don't mind, you can quickly, I mean, take the picture of that, and then we go back to use the number over there. So the equity beta, I remember 0.88. The unlevered market beta or the asset beta, that is something we need to calculate. You know the income tax rate, you know the market value of debt, and you know the market value of equity. So you know everything. You should be able to work out what is the unlevered market data. Sorry, unlevered market beta. Okay, so I quickly go back to where the question is, and then we put things in together. Uh, so that's still 11. So I go to 12. Okay, here it is. Okay, so all the number you have, am I right? All the number you have, all the number you have, right? So the first one, I mean, if you remember from that, the lever equity beta is 0.88 equal the unlever is the one you need to calculate, or the asset beta. You time with one something, the tax rate is 35%. Tax rate 35%. Market value for that. I mean, the question here they say that you assume that the market value for equity is 6705, and the book value for that is also the market value for that. So you should take 4658 million, and the market value for equity is 6705 million. Okay, so I mean on that basis you should be able to work out the asset beta. Can I ask you quickly without looking at the number, right? From your view, and this is the exam question, I guarantee with you. From your view, or without doing the calculation, from your view, the asset beta and the equity beta, which one should be higher? If the equity beta is 0.88, do you think that your asset beta is less than 0.88 or more than 0.88 and why? I guarantee it is my exam question. That pick a number that can that. Do you think that the asset beta will be higher or will be lower compared to the equity beta 0.88?
Mm, I think it is higher.
Okay, see you next year. No, without doing the calculation, the asset beta should be less than the equity beta. And why is that? Let me tell you. Okay, let me tell you now. When you learn corporate finance, right? When you look at the total risk for the company, the total risk will include business risk and financial risk. Okay. The business risk just simply what industry you are in. That will tell you the risk you are facing. And the business risk will never be equal zero. Regardless of you are operating in a very safe industry, let's say education, medical services, utilities, the business risk is still positive, right? However, financial risk will tell you when you borrow money. So if your company borrow nothing, your financial risk will be zero. So the business risk will never be zero, but the financial risk will be able to be equal zero. The equity beta will reflect your business risk and your financial risk. Whereas the asset beta or the unlevered beta, it only reflects the business risk. So that is why the asset beta should be less than the equity beta, or the unlevered beta should be less than the levered beta. I guarantee with you, it is in your exam paper. Bạn Nguyên, uh, sorry, Nguyên Hoàng right? Trần Bá Hoàng right? Can you understand my response? My Nguyên Hoàng,
Yes, yes, I'm here.
yes. Can you understand? Do you understand my response?
Uh,
No.
no, can you explain again?
Okay. We have the two types of risk. One is business risk, rủi ro kinh doanh. One is financial risk, rủi ro tài chính. Right.
Yeah.
The business risk depend on what industry your company belong. I say the business risk for Hoàng Anh Gia Lai should be higher compared to Vinamilk. Why is that? Food and beverage should be safer compared to agricultural product. Okay. So from my view, risk of Hoàng Anh Gia Lai should be higher than Vinamilk. So it is impossible for any company to have zero business risk, because regardless of what industry you are in, there will be the certain level of risk there. Okay, so that is the first type of risk. The second one is financial risk. Financial risk is when you borrow money, right? So if your company borrow no debt, the financial risk for your company is zero. Okay. If you borrow 20% and then later you borrow 90%, when you borrow 90%, the financial risk of your company will be higher compared to the financial risk when you borrow only 50%. Are you with me? Right. Okay, so that is the difference between business risk and financial risk. Now we try to link with beta. When you talk about lever beta or equity beta, right? That beta consider both business risk and financial risk. But when you talk about the unlevered beta, it means the asset beta. You only talking about the business risk. Okay, so that explains why the asset beta should be lower than the equity beta. Okay, so that is something you need to be mindful. Think about it, and then if you still, I mean, unclear, I mean, you just wait for view to leave the class. I will explain to you in Vietnamese, so then you can get it better, but I hope that you understand. View, can you get my response? View, can you get my explanation?
Yeah, I think it was very clear.
Okay. So clearly, I mean, that is something need to be very mindful. So to be honest, I don't know what is the answer for question A. Solution is not in front of me, but for sure it should be less than 0.88. Okay. So now I ask you the second question. Not you, not Nguyên Hoàng, but let's say I ask Việt An. Việt An.
Yes,
So
teacher.
now you know that the difference between asset beta and equity beta, am I right? Or lever beta and unlever beta. In the capital asset pricing model, CAPM, we use asset beta or we use equity beta. In the CAPM, capital asset pricing model, which beta we use? Linh Chi, what beta we use, Linh Chi, in CAPM?
We use equity beta.
Yes, we use equity beta. And Linh Chi, equity beta is lever beta or unlever beta?
It is lever beta.
Lever beta. It taking into account financial risk or business risk or both of them?
Both of them.
Very good. Thank you, Chi. Okay, very good. So capital asset pricing model using equity beta. Equity beta measure the systematic risk, and equity beta is the lever beta. So that take into account the business risk and the financial risk at the same time. Chánh Thống, are you okay? Thống?
Yes, teacher.
Okay, good. Minh Thảo, are you okay em?
Yes, I understand.
Thank you. Lemon, can you put the webcam down a little bit, Min, so I can see you, Min? Thank you, em. Are you okay, Min? Lemon?
That teacher.
Yes, are you okay? You understand what I'm talking about?
Yes.
Okay, good. Thu An, Bùi Thu An, are you okay, Thu An?
Yes.
Okay, good. Okay, so we move on. We move on. Now we go back to the question. Uh, okay, Khoa, can you still see the book on the screen, Khoa? Okay. So question one now easy, right? You use the formula I show you to work out beta, right? And then now we go to B, right? Compute the cost of equity. I say again, B. Compute the cost of equity capital with the new capital structure that results from the LPL. Assume that the risk-free rate is 2.4% and the market risk premium is 5%. Right. They ask you, look at the title. Look at the title. Right. They say compute. Right. Compute. The cost of equity capital with a new capital structure. With a new capital structure. What does that mean? What does that mean? What does that mean? What do I mean? It means that they want you. Okay. Hang on. Stop there, right? So for I, what you get the answer from I is you get the asset beta. Am I right? Okay, the unlevered is the asset beta, right? And now for B, you use the same formula, but now you need to work out the cost of equity. It means that you need to work out the equity beta. The equity beta now, it will not be 0.88. Why is that? Because your capital structure is now different. Are you with me? I say again, question B asks you to calculate the new equity beta. Why I say new? It means that it's not 0.88. Why it no longer 0.88? Because the cost, the capital structure is now different. The capital structure before that is debt 4.6 billion, equity 6.7 billion. So the ratio is about 40% and 60%, 40% debt and 60% equity, right? Now you move into the new capital structure. It is now 25% equity and 75% debt. So that is why you yield the same number. Okay, I say again, you use the same number. You use the same number. I'm sorry. You use the same formula. But now you know the asset beta. You know the asset beta. You just need to work out the equity beta. Okay, so I remind you the formula again. If I remember it correctly, lever beta is equal unlever beta time 1 minus, can't remember, 1 minus t debt, market value of debt divided by market value for equity, something like that, right? So it means that you need to recalculate equity beta using the same formula. You get the new equity beta. And then when you have the new equity beta, so then you know the risk-free rate, you know the market risk premium, you should be able to work out the cost of equity capital. It means the cost of equity using capital asset pricing model. Okay, are you with me? Okay, so it is B. The point is, I mean, I gave you the hint of very detailed hint for you to understand the question. Go home and do it. I will request Lynn to provide solution to you. Um, I will ask her to do it. I mean, as soon as I mean today. So I send a signal that we discussed this question in the lecture already. And then you do it. And if you look at my hint, you look at the solution, you do not understand, you need to get back to me. Okay, so I mean that is something to be mindful. Now we go for C. Compute the weighted average cost of capital with the new capital structure. So very easy. If you want to work out the cost of capital, what do you need to know? You need to know the cost of debt. You need to know the cost of equity. You need to know the weighting for debt and the weighting for equity. And the weighting very easy: 25% for debt, 25% for debt, and 75% for equity. I'm right. The cost of equity is the number you get from cost equity, the number you get from B. That's the cost of equity. The cost of debt, I remember it says somewhere here for the cost of debt. Um, here, here, cost of debt is 10%. That is the cost of debt. Okay. So the cost of equity, you get it from B. The cost of debt is 10%. The weighting for equity 0.25, then the weighting for debt is, I mean, 0.75. You should be able to work out what is the weighted average cost of capital. So that is something you need to work out. Okay, so ABC, very clear, no problem with that. Now we go to D and E. You see that there is D and E, right? They say compute the present value for the project free cash flow. And remember here, guys, you have from year 3. Again, year 3 doesn't mean that 3 years from today. You are now in year 2 already. Okay, remember they say you are now at the end of year 2. Right, you are now at the end of year 2. So year 3 is actually 1 year after that. So you know everything. You know the cash flow from here, right? You have from year 3. So expected cash flow year 3, year 4 up to year 12. And then when you go to year 12, they say that from year 13, every year it will your free cash flow will increase by uh, by 3%, right? Your free cash flow increase by 3%. They say compute the present value of the project free cash flow to all debt and equity capital stakeholder. It's not the mid-year adjustment. I need to discuss about this one a little bit. Mid-year adjustment. What does that mean? You know that the standard practice in finance is you assume that everything will occur at the end of the year, right? So that is the standard convention in finance. Everything occurs at the end of the year. That is the standard, convention. Um, However, in practice, you receive money or you pay money all over the place. So that is why there is the argument. You need to make the assumption that every year, so everything occurs in the middle of the year. So you can make the payment in January and you make the another payment in December. So on average, it will occur in June, July every year. So that is the mid-year adjustment. How we do the mid-year adjustment, I will show you in Excel file when I show you the valuation. Okay, okay. So that is the one the mid-year adjustment. So they just is not that related to assumption that cash flow occurs on average over the year. Okay, sorry, I explained here already. In computing a continuing value, apply the projected growth rate in free cash flow after year 12, 3% directly to a free cash flow of year 12. So I think that, I don't think it is important for them to say something like that. But here is my response. Right now, you know that you have a free cash flow from year 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Right. And let I remind you, year 3 is actually 1 year from tonight because you are now in year 2 already. So why they do it? They just want you to confuse, okay? But you need to be careful because they say that now you are at year 2. So year 3 is mean that 1 year from tonight. So the point for this question is they assume that you can forecast for the next 12 years. No, not for the next 12 years. For the next how many years? Go back here. Year 3 is 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. So it means that you can forecast for 10 years. And from year 11 and onwards, you assume that every year it will increase by 3%. Right? So you can use the dividend discount model in order to work out what this present value is. I go back to the slide and I show you how you can apply that. Okay, I go back to my slide. Go back to my slide here. Oh, where is my computer mouse? Come on, come on. Not this one. Not that one. Okay, okay. Minh Thuận, can you see my slide, Thuận? Yes or no?
Yes, teacher.
Okay, thank you. I go to slideshow current slide. Gee, what's wrong that? Sorry. Okay, look at this one, please. Right. What you need to do now is in the question, right? The T here is for 10 years. Am I right? For 10 years. From year 3 to year 12, it means 10 years. You just need to work out the present value. Am I right? Very easy. Why is that? You know your free cash flow. Sorry, it's not this one, the next one, correct? Because this one is for debt and equity. It's the same. You know your free cash flow for 10 years and you know the discount rate, the cost of capital you calculated from question C, right? So this represents for the first 10 years. T here will be from 3 to 12. It means that from 1 to 10. Okay. Now you use the free cash flow in year in year 12. You time 1.03. So it's been that increase by 3%. So you get this one. So this one now become the free cash flow in year 13. Divided, this one is the cost of capital, the one you just calculated. G here is 3%. The first and the second component here, just simply tell you the value at the end of year 12. At the end of year 12. For all free cash flow from year 13, 14, 15, 17, etc. And then you discount back for 12 years using the cost of capital. Okay, so that is the way you do the calculation. The first component will provide you the present value for the first 10 years from year 3 to year 12. The second component will tell you the present value for all free cash flow from year 13, 14, etc. It's been that from year 11, etc. View, can you get me view? Can you get my explanation view?
Yes.
Okay. So do you mind if I can use Vietnamese about 3 minutes? That I want to make sure that they understand this one.
Yeah, no problem.
Okay, sorry about that. Các bạn thấy là hiện tại bây giờ là mình được cho cái dòng tiền tự do là 10 năm, mặc dù nó ghi là từ năm 3 cho đến năm 12, nhưng thực ra là 10 năm là vì mình đang ở năm thứ hai, đúng không? Cái cột trước này á, là các bạn sẽ được giá trị hiện tại cho toàn bộ cái dòng tiền đó, thì đơn giản thôi, mình tính được cái cost of capital, các bạn tính được ở câu 3, đúng nè. Thì bạn lấy cái cash flow của năm 3 thì bạn chia cho 1 cộng, tôi giả sử là 10% đi, 1 cộng 10% mũ 1 thôi chứ không phải mũ 3 nghe, mặc dù năm 3 như là mũ 1 là vì các bạn đang ở năm thứ hai, đúng không? Đúng không? Như vậy bạn tính cái đó thì sau đó để mà bạn tính cái giá trị gọi là continuing value, tức là giá trị từ năm thứ 13 trở đi á. Năm thứ 13 là tên gọi của nó, nhưng mà về mặt time value là từ year 11 trở đi á, thì cái free cash flow của năm thứ 13 thì bạn lấy cái free cash flow của năm thứ 12 là con số cuối cùng bạn được cho, bạn nhân cho 1.03 là nó ra được cái con số này. 1.03 là tăng 3%. A mình mới tính và G là 3 phần. Nguyên hai cái trước này nó là cái giá trị thứ 10 bộ dòng tiền năm thứ đó. Còn nếu mà giá trị ở năm thứ 12 cho toàn bộ dòng tiền từ năm thứ 13 trở đi, nhưng đó là trong ngôn từ thôi, chứ còn về mặt ý nghĩa của nó phải là giá trị của dòng tiền năm thứ 10 cho toàn bộ những dòng tiền từ năm thứ 11 trở đi. Và do vậy bạn hiển thị lại 10 năm để nó trở thành cái giá trị hiện tại. Như vậy là cái tiền là giá trị hiện tại của 10 cái dòng tiền đó cho bạn. Còn cái cụm thứ nhì là giá trị hiện tại của toàn bộ dòng còn lại từ cái năm thứ 11 trở đi cho tới vô cùng. Okay, so clearly you need to understand, I mean, this formula will produce two components. The first component is the present value for the first 10 years. The second component is the present value for everything you are going to receive in year 11, 12, 14, 13, 15, etc. So that's what we call, I mean, the valuation for the equity stakeholder. Okay, so my expectation is, I mean, you go home and you do the calculation, and then you double check with the solution. Lynn is going to send to you, and any problem for that, I mean, you handle that on the case by case basis. The mid-year adjustment here, we will talk about it when I show you the Excel file. Okay. The last one, they say assume that buyout group requirement will determine in requirement D. Assume that the real life free cash for coincide with projection. Okay. This one I cannot answer until I say again. This one I cannot answer until we get the numbers, okay? Because if you want to see if they generate, I mean, enough money or not, you need to say, okay, I mean, what is the value from your valuation? Because look this way, okay? Look this way, okay? Let's assume that you do the valuation, and the valuation of the company is, let's say, 1,000. Okay, so if your valuation is 1,000, and if you borrow 20 or 75% debt, right? So you say, okay, 70% times 1,000 is 750. Let us assume like 750 million. I'm right. 750. You look for the cash flow here. Okay, I mean, you need 750, but you generate 798. I mean, it's not a lot, but at least it's enough to cover, right? However, if I assume that the valuation produced, you get a, let's say, 2,000, and 2,000, and you borrow 75%, it means you borrow 1,005, but you only generate 798. What really mean is you do not generate enough money. Okay, so that is the why you answer. And because we don't know what is the valuation, because we don't do the calculation yet, so then clearly, I mean, I can't answer this question, but I just tell you the example. It just depends on what is the valuation you get in question D, and you time that number with 75%. That represent the total money you own, and then the interest rate you need to pay, and then you compare with the cash flow you generate to see if it is enough for you to do it. The reason why I don't go into the detail, I mean, for the answer, just because I want to leave it for Lynn. But clearly in the final class where I do revision for you before the exam, so by that time we will do the question with the answer. But at the moment, I will request Lynn to send the solution to you for two questions I covered today. So question 12.11 and 12.12, I asked Lynn for you to send solution to you, and then you look at it, you do your own calculation. Any problem, you come back to me. Okay, so I will leave it there now. Okay, now in what time, so I show you the Excel file. Okay, and then I try to illustrate, I mean, what we mean when we look for the valuation using a free cash flow and using the dividend, the one we missed last time, right? Okay, now I will show you the Excel file, the one I showed you last time. um, um, Valuation. Sorry, just a second. Uh, Sorry, guys. Okay, I try to open the file. Oh no. Okay. Uh, okay, I'm going to show you the Excel file. Let I double check the copyright, and then if it is okay to provide you, for your, self learning, so then I'm happy to do it. But let I double check about the copyright first, because that is something I dare not take it lightly immigration, because it is about the you need to get the 5 years of data. But for some indicators, they need 2 years in order to do the calculation. Let's say asset turnover, for example, or account receivable. So you need 2 years. So that's why you collect 6 years of data. So they all the historical data from the balance sheet, from the income statement, and the statement of cash flow. And this example is the valuation for Pepsi, right? And then, when you look at the thousand of figures like this, you found it difficult for you to say what is what. So we discussed that, okay, you do some analysis, and that is what we call the financial statement analysis, where you look at all the different ratio from liquidity to asset turnover to solvency, blah, 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 blah. Why is that? Because when you put everything in ratio, you look at it, you can pick the abnormal pattern easily, right? Because that now become the smaller number for you to look at it. So that's what we call the financial statement analysis. Who did it? Whether should we as the valuer we do it? For sure we need to do it, right? The data we just simply get from the company, but there is no harm if you look at the data and you have some question. You are not auditors, but you still ask some question if you believe something worth asking, and then you do the financial statement analysis. So that's one very easy, everyone can do it. Now where you really put your money, where you really put your effort and your talent is when you develop your forecast. It means that you forecast how much revenue will increase in the next, let's say, 5 years. Okay. And why 5 years? Well, as I say, the standard practice for the variation industry is they try to forecast for the next 5 years. And then in year number 6, let it go. Because by that time, you cannot forecast. That is in the normal market condition. Let's say if you are at the moment between all the saga, happening around us at the moment, I don't think anyone can predict even for 2023. I'm right. Because we are living in a very, very unprecedented environment at the moment. Right. So you need to, develop your forecast. Okay. Revenue increase by 41% in next year, 4.2 year after, and then 6.3, in 4 years on the road, blah, 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 blah. Right. So you do all the forecast development. This is where you, as the professional valuer, put a lot of effort and talent in order to defend your forecast. So that is why I mentioned to you, all of you, including me, assume that we are in the same variation class. When we go out to work, we do the variation for the same company, we use the same financial statement, but our variation figure will be different. The reason for that is the way you look at your valuation, the way you look at your assumption, they will be different compared to my assumption, right? Because we are simply different now. So when you develop all the assumption there, now your responsibility now is you go to forecast. Forecast simply means now you forecast what is revenue for the next 5 years. Why you start with revenue? The reason for that is in order to forecast revenue, it's not easy, but at least it is the easier thing you do. Because you are in the industry, you can forecast demand, you can forecast the price, and from the quantity and the price, you can work out the revenue. And then when you forecast, revenue, you can consider if the revenue is higher, for sure the cost of goods sold will be higher. For sure, everything will be higher. But the point now is how much it should be higher. You need to look more. In order to generate more revenue, you need to, let's say, you need to have a more asset. So that is the spill over between your income statement into your balance sheet. Okay, so you see that your balance sheet, the asset will be now different, and the asset will be different in order to generate different revenue. Then it will affect how much you borrow more or how much you issue new stock more. It will translate into the right hand side of your balance sheet in terms of liabilities and owner equity, right? And then finally, when you predict for the next 5 years, for your income, for your revenue, for your expense, for your net income, for your asset, for your liabilities. So then clearly now, the final point is, okay, you go to, some of the things you believe is important for your cash flow. And clearly, the cash flow here, as the value or as the accountant, right? You can start with your net income and you work back in order to go to the cash flow from operation. I show you, last time, the cash flow from investing activities and the cash flow from financing, right? And the total, everything, it represents your final cash position in the year, and you do some cross check on that. So that is, something we need to be doing as the valuer. Now you go to the valuation, and I can tell you, in order to do the valuation, what you will see is, the way you calculate the cost of capital, the cost of debt, everything here becomes very important one for you to do it. Right? I will tell you in the different one, but what now is I say, okay, let's assume that your cost of capital is 6.2%. That sorry, 6.42%. That's your cost of capital. So this cost of capital will be used in order to discount all the value you are going to get. Right. Okay, let I go to the cash flow first, and then I will go to the dividend, right? So now valuation is about the future. I don't care what happened in the past. So when I go to the valuation, I stick with my forecast for the next 5 years. And from year number 6, I say, okay, assume that every year a cash flow will increase by 3%, and I will do it. Okay. So now let's go back to a cash flow by valuation. You can work out a cash flow from common equity. I show it to you already, right? The way they handle is, okay, cash flow from operation, look for a cash required for operation or for liquidity, look for investing, look for long-term debt, look for financial asset. It looks familiar to you, I'm sure. So everything here will tell you it is a free cash flow for common equity. Now, this is what you forecast and what you get it done. This number will become very important for you. But this is only for the first 5 years. Now, what is it you say? Okay, I assume that next year, every year will increase by 3%. And what you can see from there is, they try to increase by, in this case, actually decrease from the certain level there. Right. So here, the way they do it is they forecast the single component from here for year number 6. But in practice, we can ignore this step and we just try to yield the final number here from year 5 in order to, let's say, decrease by 5% because blah, blah, blah. It goes to the cash flow, the free cash flow for year number 6. So the way you do it is very easy. Number one, you work out the present value. So you present the present value factor. How can I get this one? The cost of capital is 6.4%. So this is equal 1 divided by 1 plus 6.4% to the power of 1. It means that you calculate the discounted factor. Right? So that is the present value component. The present value component here, you time with this one. So all the number here now tell you present value. What it really means is 6,491 in year 1 is equivalent with 6,038 now. 7,008 in year 5 is equivalent with 4,881 now. So it means that this one represents the present value. So if that present value, you add them up, you get this number. So this is the present value for your variation for the first 5 years. Am I right? Now, so that is the number, the first number. Now I need to handle the present value for year 6, year 7, year 8, year 9, year 10, whatever you can think of, right? So you see the way I apply the formula here, you see here is, the first one is clearly, I mean, the free cash flow for year 6 divided for the cost of capital minus for the growth rate. And here is the discounted factor for year 5. Because when you apply the dividend discount model, right, for using the free cash flow in year 6, it means that the value you get is in year 5. So that's why you discount back for 5 years. So this is the present value for your continuing value. If you do the question with it, you understand that. And then they all present value. The first component is the present value for the first 5 years. The second component is the present value from year 6, year 7 indefinitely. So you add them up, it goes to the total. But now we have what we call the mid-year discounting. What is that? When you look at the number 127,000 something, your assumption is every payment, every receipt at the end of the year. So now you say, no. We need to change that. Everything should be a curve in the middle of the year. So how we make that adjustment? You just year 1 plus the cost of capital divided by 2. So that is the discounting factor for mid-year valuation. I say again, you just year 1 plus the cost of capital divided by 2. So you consider for every year, right? So if that's the case, this is the total present value when you assume that everything occurs at the end of the year. You time with the discounting factor, so what you get is the present value now, but with the mid-year discounting. So that is the total, I mean, free cash flow to equity. And for this company, they have this amount of share outstanding. So the valuation is that tell you the value per share. So clearly, I mean, the key point for that is you need to work out a free cash flow for common equity. And I show you the step, you do it already. So you see that it should be very straightforward. You compare with the current price, you see that you overestimate by 25%. Okay, so that's the example. The second one, okay, this is something I will show you in the future when you do the sensitivity analysis. So this is the free cash flow for common equity. I'm surprised if there is no free cash flow for debt and equity. There should be. So sensitivity, market base, no, there should be. Oh, here. Similar, now you can do using the free cash flow for all debt and equity, right? And this one I show you, I mean, in the example last time. You start with that, you add back what, you subtract what, you decrease, you increase whatsoever you get there, and the present value factor, and then you work it out and you take into, I mean, the total present value free cash flow. Right? But this now is for debt. Okay, sorry, for equity and debt. You see that this one now including both debt and equity. Right? So what you need to do is you take out the outstanding debt, you take out the value of preferred stock, you take out the non-controlling interest, the one you own but you do not control. You add back any value financial asset if you have. So you get this one for equity. It's mean that everything here you consider it is for debt and then it's actually for equity. So the difference, I mean, there is, I mean, the way you derive the free cash flow for debt and equity different compared to the way you estimate the free cash flow for equity holder, right? And then when you get the total value, you need to take out the debt component. outstanding preferred stock, non-control interest, right? You take it out, and then you get to the present value for equity, mid-year accounting, and then you get that value divided by number of shares. You get, I mean, the estimated value per share. Okay, so that it's just the way you work out the one. We go to the one we missed last time, but it should be very similar if you do the valuation based on dividend, right? So again, I will do some question for you, maybe not next week, but the week after next week, when you use the dividend based valuation here. So I mean, the way you work it is okay. The dividend here is, you remember, dividend here is include the audit you say every 6 months, every year, and all the cash flow between the company and the shareholders. Okay, so you say, oh, in this example, so they have the dividend they pay, that's amount, common stock issue, they take it out, they repurchase, so that's why they go to the dividend to common equity, right? And then you just do the same way. That is what you get for the valuation. That. So actually, I mean, the key point for that is clearly the key concept is it's not about what you are getting here, but it's more about how you get to here, and that becomes very very important. How you get up to here, and that becomes very important for that. And you need to be very very clear on that when you do the valuation. So estimating the cost of capital is very very complicated, and I stay in that industry for 15 years by now, and a lot of debate. The reason for that is it is not the simple concept for us, I mean, to hand on. Okay, so that is my my demonstration. As I say, let I double check about the copyright issue. If there is no issue, I'm happy to flip a copy to you for your information. Actually, I did request for the model at work, but I got rejected. I mean, they say no. Even though I say I change all the number and inside, but the agency claim that is their IP, intellectual property, so I rejected my application for that, so I cannot forward you the one I intended to send it to you. But for this one, I mean, I would double check to see. I mean, this one, because this one is now 10 years. I mean, that's for Pepsi for 10 years by now. I mean, a lot of teachers use that as a case study. I think this should be developed by Harvard, for my view, for a long time ago. And then let us double check about it. I mean, you know that really in Vietnam we're a little bit casual in terms of IP, intellectual property. But I am at my university. I use a lot of case study, and I can tell you it extremely useful for students to discuss in the class. And I have 100 of them in the last, I mean, 20 years or so when I started, I mean, my career. But the thing is, you know, let's say when I request the case study, even the university pay for that. But at the end of every single pay, they say something like, this case study was requested by Dr. Đức Võ at the University of Western Australia for the unit in that semester, something like that. Anything, I mean, any use outside, I mean, by this class is a violation of the US regulation, blah, blah, blah. Look very, very scary. Very, very, very scary. So that's why all case study, I have hundreds of them, if I don't want to say thousands of them in the last 20 years, but it never be able to use outside, I mean, where it is designed to. Because let's say, if I pass it on to anyone, and for some reason you put it on Facebook, and then my name is there, you see it's a really scary, I mean, currency one you can think of. It's not about money, it's about, I mean, prison center for some country like Australia. Now, okay, guys, I mean, that should be enough. For today, again, I offer my apology for what happened in, I mean, 2 weeks ago. I did record a lecture. It should be somewhere in the system, but misunderstanding between Lynn and me, so you never got it. I'm sorry for that. I will ask Lynn to send you the solution for two questions I discussed today. Okay, I will request her tonight, and then you redo it yourself based on the hint I gave you today, and you double check with the solution you are going to receive hopefully tomorrow, or please be nice to her maybe until Friday. Okay, because I'm not sure how busy she is, and that is my request. So there's no reason why I need to request her urgently, but I will request that to her tonight. You do it. Any question you come back to me. But the plan for the next two lecture is, I try to do some question with you, especially the question I say it is the strong candidate for your final exam. And then in the last lecture, that is when I do the formal question for you to prepare the final exam. Okay, and just before you leave, if you do when you do the assignment with Kim, if you have any question you want to talk to me, you are welcome to talk to me, because by all means I am the unit controller for this unit, so I need to be responsible for everything you do, regardless of it belong to Kim task or belong to Lin task. But finally, I am the one who do the final results. I need to understand where is where. So just let me know, keep me in the loop whenever possible. Okay. Any question, email me, and all the email will be responded. Okay. So any question? The internet look okay today. Thank you very much, guys. Take good care. F0 everywhere in Saigon, but enjoy your life. Okay. Be careful, but enjoy your life. It is everywhere. In our city, we get about 4,000 cases today. It's too many. But I look at Saigon today. You guys score. You guys, have more than what I'm thinking about. So okay. So take care. And any question, email me. And thank you. And I see you in